Operating profits practically fell off a cliff, but a massive paper gain from SpaceX made the headline numbers look like a triumph. Welcome to Earnings Unscripted. It's July 22nd, 2026, and today we're unpacking Tesla, ticker TSLA, for the second quarter. Miro, they pulled in over $28 billion in revenue, up 26% sequentially, but the core auto business feels strangely fragile.
It really does, right? Because if you ignore that SpaceX valuation bump, their actual operating margin collapsed to 1.4%. For a company trading on hardware dominance, that's a brutally thin cushion.
Wait, so the entire bottom line beat, that massive jump in net income, it was completely rescued by unrealized equity?
Exactly. Core operating profit was basically cut in half, but that SpaceX mark-to-market gain essentially disguised the bleed.
Well, the market clearly spotted the bleed because the stock took a nasty hit in extended hours. It took a second leg down right as the earnings call started and closed the evening deeply in the red. And since we're picking apart a defensive tape today, remember, our banter's just personal opinion, not financial advice. But honestly, you can't blame the sellers when free cash flow turns completely negative.
You really can't. They blew through more than $5 billion in capital expenditures this quarter alone. Elon even pitched it as the fastest industrial scale-up since World War II, heavily funding the Optimus factories and Cybercab infrastructure.
Oh, speaking of robotaxis, I loved his surprisingly grounded reason for wanting satellite internet on the fleet. He complained about losing cell service on his morning commute in Silicon Valley, which he called a Bermuda Triangle of dropped connectivity.
Yeah, it turns out an AI vehicle is totally paralyzed if it drives into a local cellular dead zone.
Which sounds mildly terrifying, but their solution to the other big bottleneck, the power grid, that's honestly the wildest thing in this report. I really need you to walk me through how sticking a shipping container full of supercomputers next to a supercharger actually works.
It's basically an infrastructure hack. I mean, while traditional tech giants wait years to get permits for massive, centralized data centers, Tesla realized they already control a global power grid. They have 7 gigawatts of capacity just sitting there at their charging stations worldwide.
Okay, wait, so they literally just roll a server rack up to a charging stall? Doesn't that pull juice away from the cars?
No, it's not sharing the plug. They're tapping the main industrial grid connection. Basically, they bundle their custom AI chips with standard server components inside a shipping container. They're calling it a Megapod. Then they just drop that box at the Supercharger site. It completely bypasses the brutal permitting bottlenecks choking the rest of the industry.
That's actually kind of brilliant in a rogue engineering way. But having distributed servers everywhere, that has to be a total nightmare to maintain.
Sure, probably. But it's that or you lose the AI arms race because you can't plug your computers into a wall. And the capital expenditure isn't just going into these shipping containers. The crazy part is, they're building a dedicated semiconductor development fab down in Austin.
Hold on, like actual silicone wafers? Are they trying to become a chip foundry now?
Right. Well, they're bringing lithography mass production and logic packaging internally, not to sell to other people, but out of sheer desperation to build the Optimus robot. Elon's exact quote was, "This is going to be the hardest product to scale manufacturing that we've ever made at Tesla, because everything on the robot is new. There is no supply chain."
Wow. So if the third-party parts don't exist yet, they have to physically invent the whole industrial base before they can even launch the product?
Exactly. The initial portion of that curve, well, actually, it's totally flat because they have to make the parts that make the parts, which perfectly explains why we saw cash flow hemorrhage this quarter. You can't vertically integrate a new tech sector on a shoestring budget. Management just casually mentioned they expect full-year capex to cross $25 billion.
That kind of budget is, it's astronomical for a company dealing with bleeding auto margins, which brings up the money. If core profits feel squeezed, how do they afford to build an entire robotics supply chain and a decentralized surfer network?
By breaking one of their oldest rules. For years, the whole narrative was that Tesla was structurally different from legacy automakers because they operated virtually debt-free.
But now they're actively setting up debt facilities for up to $30 billion in new borrowing capacity.
That feels like a massive philosophical shift, leveraging up just to keep the AI projects moving.
Yeah, it completely rewrites the story. They're betting the entire balance sheet that Optimus and autonomous driving hit before the bill comes due.
And if that timeline slips, adding all that leverage is going to make the market incredibly nervous.
Yeah, it changes the risk profile completely because they're telling us this spending isn't just a seasonal spike. Tunasia explicitly reaffirmed they expect capex to cross $25 billion this year and that it'll keep climbing for the next couple of years.
Which means they really need the software side of the business to step up, right? I mean, they noted about 55% of North American deliveries are activating FSD right off the lot now.
Right, although actually the real tell there is how fast they can recognize that deferred revenue. People aren't treating it like a weird enthusiast perk anymore. It's becoming a default feature. But to count that cash, they have to hit those safety validation milestones they call the March of Nines.
Okay, so for next quarter, we're essentially watching whether software cash flows can sustain the robot and data center buildouts.
That, and we really need the energy storage segment to stop throwing surprises. They took a $240 million warranty penalty this quarter for some legacy vendor cells. Management guided that those margins should eventually normalize in the mid to low 20% range. But right now, the volatility makes it incredibly hard to model.
Fair point. So they're not operating debt-free anymore, and they're definitely not just making cars. It's becoming this massive, highly levered bet on solving generalized AI. Fascinating quarter.
Always a pleasure. Catch you later.
If you're enjoying catching up on the quarter this way, go ahead and hit follow on your podcast app. And just for full transparency, the two of us are entirely synthetic, and this whole show is AI generated, turning today's massive Tesla filings into an audio conversation in just a few hours. We're always taking requests for what company to cover next, so drop us a line at earningsunscripted@datamandis.ca or find the X link in the show notes.
Talk to you next time.